Okay, let's dive in. Today we're tackling a really interesting, almost countercultural idea in investing the permanent portfolio.
Yeah, it definitely goes against the grain in some ways.
We've gathered, a whole bunch of sources, original writings, modern research analysis, to really unpack this thing.
Get under the hood a bit.
Exactly. Our mission is to, cut through the noise, pull out the most important ideas, and help you understand the strategy that Harry Browne created.
And maybe understand why it keeps coming up, especially, when things feel so uncertain.
And that uncertainty, that's really the heart of it, isn't it? That's what Browne was trying to solve.
Absolutely. Browne was deeply skeptical. I mean, really skeptical of anyone claiming they could predict the future. Economists, analysts, you name it. He had that famous line, "Uncertainty is a fact of life." And his whole investment approach, this portfolio, it came straight out of that belief. We just can't reliably know what's next for markets or the economy.
Which flies in the face of pretty much everything we're usually told as investors. Always looking for that hot tip, the forecast.
Right. Where's the market going next? And Browne basically said, look, trying to find that certainty, trying to predict, it's not just pointless, it could actually be dangerous. Betting your future on a guess, that's risky.
So, okay, if you're not trying to predict, what was the goal then?
It was actually pretty radical in its simplicity. Build a portfolio that's designed not to hit it out of the park in any one specific environment, but to do reasonably well.
Okay.
Or, and this is key, to survive without getting totally wiped out no matter what the economy is doing.
And he broke down those economic conditions into, four main types?
It did. Prosperity things are good. Recession things are bad. Inflation prices are soaring. And deflation prices are falling.
Got it.
And the idea is you need parts in your portfolio that can handle each of those. Success isn't about maximizing gains in a boom. It's about being resilient, through all kinds of weather. It completely reframes investment success.
And, something our sources really emphasized, which I found interesting, was the psychological side.
Ah, yes. That's huge.
If you genuinely believe your portfolio is built for anything and you stop trying to guess the next move, that's got to be a huge stress reliever.
It's probably one of the biggest, maybe most underappreciated benefits. Browne talked about investors being able to leave financial worries behind. Think about the emotional toll of constantly watching markets, trying to predict, maybe panic selling or chasing hot stocks. Those are the behavioral mistakes that wreck long-term plans. This strategy, aiming for stability, is like an antidote to that anxiety.
Okay, so the core philosophy, humility, resilience.
Yeah.
Got it. Now, how does that actually translate into an investment portfolio? The how.
Right, the mechanics. And this is where it gets interesting because it's so strikingly simple. It starts with the asset allocation.
And it's almost, ridiculously simple.
It really is. The classic version is just 25%. Exactly 25% into four things. U.S. stocks, long-term U.S. Treasury bonds, cash, specifically short-term T-bills, and gold.
Okay, let's unpack that. 25% stocks, that's for growth when times are good, right? Prosperity.
Exactly. Your standard broad market index fund, usually. When the economy's humming, businesses are doing well, people are spending, stocks are meant to be the engine.
And 25% in long-term U.S. Treasury bonds. These are the ones sensitive to interest rates.
That's the key point. They're long duration. Yeah, they provide some income, maybe some stability during good times, but their main job is deflation protection.
How so?
Well, in deflation, prices fall, interest rates usually drop too. So these bonds, with their fixed higher interest payments from before the drop, become much more valuable. Plus, they tend to be a flight to safety asset when things get scary.
Okay. Then 25% cash, but T-bills, not just bank cash. Why?
Yeah, Browne was cautious about a counterparty risk. A bank could fail, even if it's unlikely. T-bills are direct IOUs from the U.S. government, considered super safe. This cash pile is your anchor in a recession or a credit crunch. It holds value when other things might be falling, and critically, it gives you dry powder to buy cheap assets when everyone else is panicking.
And the last 25%, gold.
Oh.
The controversial one sometimes.
Yeah, gold. It's the classic hedge for when things go really wrong. Inflation hedge, sure, but also historically a safe haven during, say, geopolitical crises or when people lose faith in currencies.
But it's volatile, doesn't pay interest.
True. And critics point that out. But Browne's thinking was, you hold 25% not because you expect it to give the best returns year after year, but because you absolutely cannot predict when you might desperately need that specific kind of protection that gold offers when maybe everything else is tanking. It's insurance.
So, stocks for prosperity, long bonds for deflation, cash T-bills for recession, gold for inflation or crisis. Covers the four bases.
Precisely. And the real magic, the secret sauce, as our sources put it, isn't just the four ingredients, it's the mix. It's radical diversification.
Based on them not moving together.
Exactly. Based on low or even negative correlation. It's not just owning different stuff, it's owning things whose reasons for going up or down are fundamentally different, even opposite depending on the economic climate. William Bernstein had a great quote about it, saying the correlation between these four is, 1, rarely seen in finance, 4, non-derivative assets populated entirely by near zeros.
Wow.
So the idea is when one part is struggling because of, say, inflation, another part, like gold, should be doing well, smoothing out the overall ride.
And the equal 25% weights. This still feels odd.
Yeah.
Why not put more in stocks if you think they'll grow more?
That 25% is Brown basically saying, I don't know. It's acknowledging ignorance about the future. If you truly don't know which of these four will do best next, the most honest approach is to weight them equally. It avoids the temptation to guess or time the market.
But, okay, there has to be a downside. You can't get that kind of safety without giving something up, surely?
Oh, absolutely. There's a trade-off. The big one everyone talks about is potentially lower long-term returns compared to, say, a 60-40 portfolio, especially during really strong bull markets.
Because you're capped at 25% stocks and holding all that cash and gold.
Exactly. You're deliberately limiting how much you participate in the big upswings.
And the data shows that, right? We saw that 1976-2016 comparison. Permanent portfolio around 8.65% a year, 60-40 over 10%. That adds up over time.
That's the price you pay for the protection, a potentially lower long-term compound return.
But the flip side is?
The flip side is a much smoother ride, less volatility. That same data showed the permanent portfolio's standard deviation, a measure of choppiness, was significantly lower, 7.2 versus 9.6 for the 60-40.
So fewer gut-wrenching drops.
Exactly. That stability is what you're buying with potentially lower returns.
And there's that behavioral cost, too, you mentioned.
Yeah.
The FOMO, the fear of missing out.
Oh, yeah. When stocks are ripping higher and your portfolio is just kind of steadily plodding along, it takes real discipline not to abandon ship.
I bet.
The actual permanent portfolio fund, PRPFX, you can see it in their asset flows. Money pours in during crises when stability looks amazing, but then it can flow out when everyone else seems to be getting rich in a bull market. Sticking with it is tough.
And that discipline, that sticking with it, is actually built into the strategy, isn't it? Through rebalancing.
Yes. Rebalancing is pillar #3, and it's absolutely critical, the non-negotiable part, usually done once a year.
And that just means bringing everything back to 25%.
Exactly. So if stocks had a great year, and they're now, say, 35% of your portfolio, and maybe bonds lagged and are only 15%.
To sell some stocks.
You sell the winner, the stocks, to get them back down to 25%.
Or buy the loser, the bonds.
And use that money to buy more of the loser, the bonds, to bring them back up to 25%.
Wow. That feels so wrong emotionally. Sell what's working, buy what's not.
It feels totally wrong, but that's the genius of it. It forces you to systematically sell high and buy low. It prevents the portfolio from drifting and becoming dominated by whatever asset class has done well recently. It maintains that crucial diversification. Without it, the whole strategy falls apart.
Okay, so we have the philosophy, skepticism, resilience. We have the mechanics, the four assets, equal weight, rebalancing. Now the big question, how did this actually hold up in real-world crises? Did it work?
This is where it gets really interesting looking at the track record. Our sources give some good examples. Take 1987, Black Monday.
Huge sudden crash.
Massive shock. The market plunged. But a hypothetical permanent portfolio, down only about 4.5%. Compare that to a 60-40 portfolio, down over 13%. Big difference in cushioning the blow.
Wait, what about a longer crisis, like 2008? The global financial crisis.
Right, that was a slow-motion train wreck. In 2008, the actual PRPFX fund lost about 8%. Back tests of the theoretical portfolio suggest a maximum drawdown, like the biggest peak-to-trough loss, around 18-19%.
Still painful, but...
But compare that. S&P 500, down around 37% peak-to-trough. Even a 60-40 was down maybe 22%. So yeah, dramatically better protection. Gold and Treasuries really did their job as safe havens then.
And more recently, 2022 was nasty, because stocks and bonds fell hard together. That's supposed to be the diversification benefit of 60-40.
2022 was a brutal test for conventional diversification, absolutely. The permanent portfolio wasn't unscathed. It was down maybe 11.6% or so.
Which isn't great.
But way better than the benchmarks. 60-40 was down over 22%. S&P 500, around 18%. Long bonds themselves got crushed, down almost 30%.
Wow.
In that environment, having the gold, having the cash, having that truly non-correlated mix really helped buffer the losses when the traditional stock-bond relationship just broke down.
So the lesson from these crises seems to be that real diversification across fundamentally different drivers matters most when things get really ugly.
Exactly. It's not just about owning different stock sectors or whatever. It's about owning things that react differently to different economic stresses.
What about longer periods? Like the stagflation of the 1970s, high inflation, weak growth.
Yeah, the backtest for the 70s looked pretty good. Average annual returns maybe around 13%. Gold was obviously the star performer then, doing exactly what it was supposed to do.
And what about rising interest rates? That period from, say, 77 to 81? Bonds must have hurt then.
They did, but the overall portfolio still did relatively well. Backtests show it returned nearly 12% annually, actually beating the S&P 500 during that specific rising rate period.
Yeah.
Well, gold and cash helped offset the bond losses. It shows the portfolio can mitigate damage even when one component is struggling.
That's interesting because the big worry people have now is that huge allocation to long-term bonds in a world where rates might keep rising.
It's a totally valid concern, and honestly, we haven't had a really long sustained period of rising rates since the early 80s. The PRPFX fund actually launched in 82, right near the start of the huge bond bull market.
So the fund itself hasn't really been tested by decades of rising rates.
Exactly. Its own history is mostly during falling or low rates. The 70s, early 80s data gives us some clues that the mix can handle it better than, say, just owning bonds. But yeah, future performance in that scenario is still a question mark, which ironically loops back to Brown's whole point about uncertainty.
True. And what about the flip side? The lost decade for stocks? 2000, 2009?
Oh, it's shown then. The S&P 500 basically went nowhere for 10 years, right? About 1.6% a year. The PRPFX fund averaged around 11% a year during that same period.
Oh.
It really shows its strength in preserving capital and generating returns when equities are just dead money or worse.
Okay, so it seems like the pattern holds. Shines in tough times, sideways markets, offers protection, but lags when stocks are really booming.
That's pretty much the summary, which leads us nicely into the criticisms, the weak spots.
Right. No strategy is perfect.
And the biggest one, as we've said, is that potential for lower long-term returns compared to more aggressive portfolios, especially when stocks are flying high. That 25% cap really bites then.
And people argue it's just too conservative, right? Especially for younger investors with decades to go.
That's a very common critique. If you're 30 years old, maybe you should be taking more risk for potentially higher growth, accepting the volatility because you have time to recover. Prioritizing capital preservation, that much might mean leaving a lot of potential wealth on the table over 40 years.
And those cash and gold allocations, they can feel like dead weight sometimes.
They absolutely can, especially when interest rates are near zero and there's no inflation scare. They just sit there not earning much. But again,
that's the price of the insurance.
Exactly. You can't get the stability and crisis protection without holding assets that behave differently, even if their standalone returns are often lower. It's inherent in the design.
What about the gold allocation itself? 25% seems like a lot for something so volatile with a near zero long-term real return. Is its hedge even reliable?
That's another fair point people raise. Gold's correlation isn't perfect. It can be very volatile itself. Is 25% the magic number? Some argue maybe 10% or 15% would provide enough diversification benefit without such a potential drag.
But Brown's logic
would say you hold 25% precisely because you don't know when that unique, non-correlated crisis hedging property will be absolutely essential. It's about preparing for the truly unknown unknowns, not optimizing for expected returns.
So it really is like that analogy we heard, the sturdy all-weather ship.
Yeah, I like that one.
It's built to get through any storm, keep moving forward, but it's definitely not a speedboat designed for calm seas and maximum velocity.
That nails it. It's not the fastest, but it's designed to bring you into port safely no matter how rough the journey gets. Its suitability really depends on the person.
Who is it potentially good for?
Maybe someone deeply risk-averse, someone who really prioritizes sleeping well at night over maximizing every last bit of return. Someone who knows they tend to make emotional mistakes.
Panic selling, chasing trends.
Right. Or someone already in retirement, maybe terrified of a sequence of return risk, a big drop right after they retire. For them, that stability could be invaluable.
And who is it probably not for?
Probably not for the young accumulator solely focused on growth. Probably not for someone who thinks they can successfully time markets or pick winning sectors. And maybe not for someone needing really high withdrawal rates in retirement where that potentially lower average return might not be enough. You have to value that consistent, less bumpy ride.
Okay. So let's say someone listens to all this and the philosophy resonates. They like the idea of preparing for anything, the simplicity. How do they actually do it? Do they need a special fund manager?
Surprisingly, no. That's one of the cool things about its simplicity. The core idea is really accessible. You can pretty much build it yourself using standard low-cost ETFs. The DIY approach.
So just buy 4 basic ETFs.
Pretty much. For the 25% U.S. stocks, you could grab a total market ETF like VTI or maybe an S&P 500 one like SPY. Expense ratios are tiny, like 0.03% or 0.09%.
Okay, long-term bonds.
Something like TLT or VGLT. Again, low costs, maybe 0.15% or 0.04%.
Gold.
Popular choices are GLD or IAU. Their expense ratios are a bit higher, maybe 0.40% or 0.25%. And just a quick note, these fees change, so you should always check the current numbers yourself.
Good point. And the cash T-bills piece.
ETFs like BIL or SHV track short-term treasuries. Expense ratios around 0.14%, 0.15%.
That DIY route sounds way cheaper than paying a management fee for a fund like PRPFX.
Generally, yeah. Lower costs, maybe better tax efficiency if you're careful about where you hold things and how you rebalance. It makes the strategy available to almost anyone.
But what's the catch compared to the actual PRPFX fund?
Well, the PRPFX fund managers do tweak the allocations slightly. They might hold some silver, Swiss francs, different types of stocks based on their interpretation of Brown's ideas. So it's not exactly the simple four-way split.
Right.
The DIY version sticks to the pure 4 assets. Also, crucially with DIY, you have to do the rebalancing yourself. Every year, you have to have the discipline to sell the winners and buy the losers. The fund does that automatically.
And the fund has a management fee.
Right, which historically has been higher than the blended cost of just holding those 4 ETFs. So DIY is cheaper, simpler maybe, but it puts all the responsibility for discipline squarely on your shoulders. No tinkering allowed.
That discipline point seems key. Okay, stepping back. Whether someone adopts this portfolio or not, what's the single biggest takeaway, the most powerful lesson it offers any investor?
For me, it's the profound importance of genuine strategic diversification. Not just owning a bunch of different tech stocks, right?
Yeah.
But owning asset classes specifically chosen because they're expected to behave fundamentally differently across those distinct economic seasons: prosperity, recession, inflation, deflation. It's really a masterclass in building resilience by admitting you don't know what's coming.
Takes us right back to Harry Brown's core message.
Exactly. It echoes his rules like beware of fortune tellers and build a bulletproof portfolio. It says humility isn't weakness, it's the foundation of prudence. It pushes a much more robust regime-based view of diversification than just, say, a simple 60-40 mix often represents.
It really makes you look at your own portfolio and ask, is this thing truly built for conditions I can't foresee? Or am I just betting on more of the same?
That question alone is incredibly valuable. The fact that the permanent portfolio is still discussed so much, despite its quirks and criticisms, tells you something important.
What's that?
It suggests there's a deep human need for strategies that offer not just returns, but also psychological comfort, simplicity, and a defense against our own worst behavioral impulses. Maybe optimal isn't just the highest number on a spreadsheet. Maybe it includes being able to stick with the plan.
So, Harry Brown's permanent portfolio. It's really a testament to preparing for the unknown. It forces us to think about what safety really means and what price we're willing to pay for resilience.
Absolutely. And while it's definitely not for everyone, those core lessons, humility, truly strategic diversification, building for resilience, those are valuable for absolutely any investor, no matter what strategy they ultimately choose.
So maybe a final thought for you, the listener, to mull over. If the real goal isn't just maximizing returns next year, but ensuring you can survive and thrive financially over your whole lifetime, through all the economic storms, the predictable and the totally unexpected, what's the right balance of growth potential and genuine, all-weather protection that fits you, your goals, and your own tolerance for the market's inevitable surprises?